Stephen, what do you make of that? They reversed a third of the cuts, and they're pumping 10 million barrels of oil a day again.
I can't say that we can be all too surprised. I think the real surprise in headline was maybe a month ago when OPEC claimed they were close to 100% compliance. Let's take that in for a second. 100% compliance. I will believe O.J. Simpson will find the real killer before I will ever believe that OPEC is anywhere near 100, 90, 80% of compliance. So I think what we have here is what we could have seen and what we've been talking about in the Shurk report since November is the fact that, yes, you might get these headlines out of OPEC, but there was going to be a supply response from North America. And indeed, after North American production hit its nadir in the third quarter of last year at 8.5 million barrels a day, the United States alone has added 500,000 barrels a day of oil back into the market. So what has happened now is OPEC had that initial response. It got oil back up over $50 a barrel. We stayed there between November and most of February, between $50, $55 a barrel. Lo and behold, the United States, you cannot swing a cat in this country without hitting a barrel of oil. We're sitting on record stocks. Production is very strong. And indeed, we're back below $50 a barrel. And I think the signal has been sent that OPEC cannot talk the market higher.
So, Stephen, and I love that you bring that up in terms of shale, because if you have shale rising 100,000 barrels of oil a day in April, potentially from the IEA, at the peak, it was 90,000 barrels a day. So we've surpassed that 2013, 2014 peak. The story, though, was that the Saudis were going to do anything that they could to really rebalance those inventories. Can we take this number at heart, or is it going to be kind of the average over that 6-month cut?
Absolutely. We're going to have to look at the average. I've been very skeptical on Saudi Arabia and OPEC's ability to talk and move this market higher. First and foremost, there's been this misnomer out there for the past 3 years that OPEC is trying to destroy North American production. That is not the case. Saudi Arabia specifically cannot destroy the North American production because it is too strong. And what we've seen over the past 3 years is OPEC has done the U.S. a tremendous favor. It forced the industry, the oil and gas industry, to retrench, to become more productive. U.S. oil producers are now putting oil onto the market at greater margins at lower prices. Saudi Arabia has learned that lesson that they cannot destroy. So there is no silver bullet or piece of garlic that's going to destroy this oil Dracula that is U.S. production as far as Saudi Arabia and OPEC is concerned. So at this point, the general concern now is how low can we go?
Yeah, that's the question, Stephen, and I love all your analogies today. But you've Kuwait saying that you could see the risk of oil dropping to $45 a barrel on that increased shale. We're trading at $48.05 now for WTI. So what's the downside? How fast do we get there?
So right now, given just the technical targets right now, if you're a Fibonacci guy like myself, I'm looking for oil could fall, and I'll look for support in between 47.20 and 45.30 in the spot market. That is a key technical area. Beyond that, obviously, we can continue to go lower, but I would certainly expect to see support again in between 47.20, 45.30. Right now, if you are short oil or if you are bullish oil, your only hope at this point is the season. We're now at the worst possible season as far as demand is concerned because refineries are in their maintenance season. So refineries are not drinking up a lot of oil right now. But in the weeks, in the months ahead, oil demand in the United States and in the Northern Hemisphere, for that matter, will increase as we come out of our seasonal maintenance and as we prepare to bake a lot of gasoline for the upcoming summer driving season. So right now, demand is at its starkest, but keep in mind that demand will pick up over the next couple of months, and it will continue to trend higher and peak sometime in late July and early August. So the bottom line here is if we are going to see an end to this downdraft in oil, from a technical standpoint, I would expect to see the support hold, again, 47.20 to 45.30. From a fundamental standpoint, I would expect to see demand starting to pick up in the weeks, months ahead. And so Bottom line is, if we're going to see a halt in oil prices, it's going to happen between here and $45.30, and it has to happen over the next 1 to 2 months. If we get into May,
Right.
June, July, and we still have this tremendous overhang,
Hey, Stephen.
and OPEC is cheating, yes.
Stephen, is there another explanation for pumping 10 million barrels of oil a day, in that the heavy crude market has become quite tight? If you look at Dubai prices, for example, it's the light sweet crude that has become very, very flush with oil, because that's what we produce here in the U.S. That's what the OPEC was not cutting. Can you make the argument that part of the oil market is extraordinarily tight, and that's why Saudis have increased?
Absolutely, it's a fair assumption with regard to the dips right there, and exactly this is what Saudi Arabia is looking for. But keep in mind that they're also price sensitive at this point, and it also comes down to a matter of market share. So Saudi Arabia is putting oil onto the market, and again, we're taking these numbers at face value, again, to preserve their market share. And who they're trying to preserve their market share for? Well, it's not against the United States, even though the United States is becoming an export of oil, but we're exporting our surplus oil. We're exporting the expensive stuff,
Right.
the sweet stuff that we don't necessarily need. Saudi Arabia is still competing with especially their age-old rival, Iran, for market share in the Pacific Rim. So indeed, so this certainly is a tight market, but OPEC and Saudi is trying to fight to preserve their own market share.